Joined by Saswata Guha, the Director of Financial Institutions at Fitch Ratings. Good morning, Mr. Guha, and thanks so much for joining in. First, in your assessment, what is the extent of stressed assets in F517 and how might it pan out in F518?
Yes, so in terms of our estimates, we expect the overall stressed assets for the system to be around 12.5 to 12.6% for FY17, and we do not expect a material reduction in these ratios for FY18 as well. Of course, I will caveat that in light of the recent developments, particularly around NPL resolution, and I'm referring to the government ordinance that has now empowered RBI to enforce, a resolution of assets, basically enforce banks towards faster resolution of assets. So if we see some action on that front, then perhaps the numbers, we could see some amount of decline in the numbers. But on balance, I think more or less the numbers will likely remain sticky for a simple reason that we also expect some amount of NPA accretion to continue.
Okay. Mr. Guha, given the high provisioning requirement, do you see banks actually falling short on capital, and hence are you likely to say downgrade any or maybe many of them?
So, as per our analysis, what we are seeing is that now I'm assuming that so we sort of looked at the capital shortfall at two levels. One, assuming a provision cover of 75% from wherever the individual bank-specific provision covers are, and the other is looking at 100%, a more extreme sort of a scenario. I'll talk about the 75% primarily, and even there, what we see is that most of the state-owned banks, barring maybe perhaps some of the bigger ones such as SBI, BOB, to an extent even Canara, most other public sector banks, capital will not be adequate should the provision cover move upwards closer to 75%. And this sort of 75% number is essentially, the logic behind the number is what, we think that, many of these stressed assets that are currently residing in the bank's books will require a provision of around closer to around 70-75% for them to become attractive for either, in terms of from a viability perspective or for external investors or ARCs. So that's, basically the logic of a 75.
Okay. Are you saying loans have to be provided up to 75% of value, only then will they possibly be bought? Or do you mean that in many cases 75% of that loan is, say, unsustainable?
Well, if you look at the crux of the problem, which is primarily the 20-30 loan accounts that the government or the authorities often keep referring to, then yes, we think that haircuts on an average of around 75%, in our opinion, will be required if they have to appeal to external investors.
Okay, so stress loans are about 12.5% of the entire system. Two-part question, sir. First, if you could tell us what would that number be in absolute terms, say in lakh crore? And secondly, how much would have to be written off as unsustainable or unpayable?
See, in terms of hard numbers, I think in our case it was, closer to around 11 odd trillion. We obviously been looking at it from a stressed asset perspective. Sorry, not 11, I think it was closer to 12.5 trillion if I'm not mistaken. But clearly, I think, we are looking at it from the perspective of, how much haircuts are required for some of these loans to become viable. Now, either they could remain on bank balance sheets or they could perhaps be sold off. And clearly what we're seeing is, when I refer to that 75% sort of a provision cover, we think that the haircuts, or perhaps that is the amount that needs to be written off for particularly these key loans, which probably account for around 40 to 50% of the total NPL mix, and are the chronic stress cases, is what eventually will have to be written off by banks. But having said that, I think if you look at the way write-offs have increased in banks across, I think it's a clear indication that the sector as a whole is increasingly resorting to write-offs as a way to clean up their NPL stock.
Okay, all right, Mr. Guha, we're going to wrap it up on that note. Thanks very much.